Well, look, a lot has been said about the overall size and scope, and just to give everybody a lay of the land here, you've got $3.8 trillion in assets on the Charles Schwab side of the aisle, and then on the TD Ameritrade side of the aisle, you've got nearly $1.5 trillion. You combine those, you get well north of $5 trillion, which could leapfrog this entity ahead of State Street, ahead of UBS, and potentially Vanguard as well, put them at number 2 behind BlackRock at $6.5 trillion in assets. And I would 100% agree with what's being said up until this point. Another item, you got 19,000 employees for one company and 9,000 for another. The play, I was there for 13 years, and play number one in a scenario like this is to try to let your customers know that it's going to be business as usual. There isn't going to be any change, so to speak. But the reality is, when you have a deal of this size and scope, there are a lot of questions, not only from people inside the company themselves, but the customers. And TD Ameritrade has had a great focus on the active trading customer, and that just wasn't Charles Schwab's business model, right? They were creating guidance and deeper, longer-term relationships. And a question, I think, for customers going forward, especially the more active ones, is what, if this goes through, what is the dedication to the self-directed retail investor?
Victor, you're the CEO or the founder of a startup that's been looking to take on these brokerages and disrupt the industry. Is this going to change your strategy, and what do you think it does to the startup landscape more broadly?
Yeah, well, first, I'll answer the landscape. I mean, there's a lot that's been said around potentially the limited number of choices. And what I have to remind everyone is there's 3,700 registered brokers in the United States. 178 of them have more than 500 registered representatives. 100 of them are more than 1,000. And the reality is, a lot of the disruption that has been caused recently are by people with much less than 500 employees, because the way you would build a brokerage firm today is very different than how you build a brokerage firm 40 or 50 years ago. So I'd say for us, it's business as usual, as well as for our parent company, Tasty Trade, and by way of affiliation, Tasty Works. We build great technology, and just yesterday we rolled out a stock referral program. Anyone that opens an account with us is going to get free stock. We're dedicated to a new generation of traders who want to eliminate friction and ultimately get a better understanding of risk. And I think large integrations like this, while they're attention and headline grabbing, the question is, it tends to take a lot of focus to make something like this happen, and it takes a lot of focus right from delivering to your end customer.
Stephanie, to what extent does this now mark the end of the peak of competition between these players that allows you to start to get back in, or is it just the beginning?
Oh, I just think it's the beginning, really. And you really do want size and scale. So now you have the 4 biggest players with over 50% of the share, right? So that's important. To me, the most surprising action from a stock point of view today is E-Trade. There is no doubt in my mind that this company gets bought. And the fact that it's down so much, I know that it was crowded with the hedge funds. I wouldn't be surprised to see Morgan Stanley, Goldman Sachs, JP Morgan, Citigroup.
But some people thought TD could buy it, and that's why it's down today.
Absolutely. So it's a short-term phenomenon. I think that's your opportunity, though, because I do think they've got to be a partner with someone. They're not going to be able to stand by themselves. And they have a very good corporate service stock plan, 25% of their revenues. So that's very attractive with good deposits. So I'm just looking at it from a performance point of view. I'm very surprised at the action in general.
Victor, I want to get your thoughts on this idea of Henry that CNBC's Kate Rooney was just talking about. High earning, not rich yet clientele, yeah. and this idea of churn.
Looked at me as you ended that sentence.
Well, I was trying to make sure I had it right. But this idea of churn and this idea of people coming into the industry through startups like, say, yours, and then maybe moving up to a Schwab down the road. Is that a trend that you've seen, and how do you make sure that that doesn't happen, given the fact that we do now have all this consolidation and it's just gotten that much more competitive?
So first, I would say that's exactly what we set out to do at Doe. It was, we all came from large incumbent institutions, and the focus there was on people nearing retirement with over $250,000 of investable assets. And with the advancements in technology and efficiency, and we felt we had a major opportunity to create an experience for those that were younger in age or had less assets, but with the opportunity over time to grow those assets. So we're familiar with the acronym, and that's exactly who we've been successful at engaging up until this point. To what I would also add to an earlier point that was made is this is not just fintechs. I mean, if you look at what we've heard over the last 12 months from major technology firms, remember, in technology, 11% of their overall revenue is coming from financial services. So whether it's Facebook looking at cryptocurrency or whether it's looking at Facebook Pay, whether it's Google jumping into checking accounts, or even if you want to count Tesla essentially underwriting their own insurance, there is a trend here with large technology companies as well as disruptive startups like us making things more efficient for everyday investors. And while scale is effective for that, really, in order to compete, it's going to be about capabilities in the long term.
Victor, put this merger aside, to what extent has the price wars that ensued when Charles Schwab began it amongst the big guys really damaged your business?
Well, look, we said all along that paying commission to trade stock was going to be about as common as paying for a landline telephone. We knew it just wasn't going to be the case. Now, I don't think any of us thought it was going to happen 3 weeks into our launch, but it doesn't change anything about what we're doing. We knew we were going to build a brand that wasn't predicated on $0. And I think once that novelty wears off in a couple of months, you have to go back to messaging on what your real value proposition is for your end customer. And we're building a great brand. We're giving customers free stock regardless if they deposit with us, because we want them to understand the concept of risk, so they get to participate in the upside without downside risk. So look, was there a short-term impact? I'd be lying if I said there wasn't. Immediately after, we had our highest couple of days or weeks of brokerage account openings, but that short-term blip lasted a couple of weeks, and we're now seeing those pre-levels that we saw before the announcements.
But Victor, to be clear, although you don't charge an arbitrary commission, you do make money every time they trade.
Yeah, that's exactly right. I mean, there is a order rebate that we, as well as many other fintechs, as well as these large incumbent brokers, take advantage of. But as the transaction cost obviously goes away, that's why assets and spread-based assets become so important. That's why scale becomes so important. And obviously, that's one of the key drivers behind, I'm sure, the discussions between Charles Schwab and TD Ameritrade.